Today, business lender Judo Bank revealed its first results as a public company. Its pro forma profit after tax was $9.1 million. That's more than forecast when the shares listed last year or so. But as other recently failed neobanks have discovered, achieving scale is more challenging than starting up. Joining me now, the co-founder and CEO of Judo Bank, Joseph Healy. Joseph, look, you've now got a loan book of around $6 billion, but where do you need to be to get to a form of critical mass, as it were?
We've said that we want to get to $20 billion, which we see as would put us at scale. So we've publicly said that over the medium term we want to build a lending book of up around $20 billion.
And how quickly do you think you can get there? Because you're obviously going pretty quickly right now.
Well, you know, the results that we announced today, which are, in judo parlance, I would say were a black belt set of results, show that we grew our lending book just over $2.5 billion over the last 12 months. We've said to the market today that in terms of guidance that we will grow that to over $9 billion by the end of June 23. So I think that puts us very clearly on the pathway to the $20 billion that we've set as a medium-term target. So very good momentum in the business.
Okay, so interest rates are rising right now. That historically puts pressure onto small businesses in particular, and those with debts are more exposed. You're in that space. Does it add risk to your business?
Well, I think if there's a risk in the economy, obviously small businesses are that risk is heightened. But we've done a detailed analysis of our customers, particularly those customers in sectors that are more susceptible to rising interest rates, rising inflation, and supply chain problems. And the quality, the strength of the portfolio is very strong today. Now, clearly, forward-looking, much is going to depend on where the cash rate ends up at. But from the perspective that we have of the small to medium-sized business economy, it is marked by strong resilience, generally speaking, with some pockets of weakness. But there's nothing that we see today that causes us any undue concern about the outlook for the next 12 months.
Okay, so the one area you have called out, and I know that I spoke to the Commonwealth Bank, and there Matt Common identified the same area, commercial property. But what you say is that the concentration has been proactively reduced. Is that an area that you see as a key risk right now?
It's an area that we've been watching for the last 12 months. I mean, not just because of the potential for rising interest rates, but just generally changing working habits with less people coming into the CBDs. Which puts risk on office valuations, and then of course the knock-on effect is that small businesses, the restaurants and the cafes that depend a lot on CBD foot traffic, they are also potentially under pressure. So we made a conscious decision to reduce our portfolio weighting in commercial real estate, and that's something we've been managing over the course of the last 12 months. We're still lending into the commercial real estate sector, but reducing our overall portfolio weighting. It's clearly a sector that history tells us that you have to watch carefully should the economy soften in a rising interest rate environment. So cautious approach, but still supporting good commercial real estate investment.
Okay, so one other aspect that you did note today, and that is that as interest rates rise, your net interest margin rises faster than even the established commercial banks. Just explain why that happens.
Right. Well, we're a pure play small to mid-sized business lender. And so as distinct from a mortgage lender where the prices are very much set and at a commoditized level, small business lending is priced very much depending on the risk of the individual borrower. Now, we have over 90% of our lending priced off 30-day BBSW, so it's floating rate. And so as interest rates increase, that's then passed on to the end borrower. On the liability side of the balance sheet, much of our funding is from term deposits with an average duration between 9 and 12 months at a fixed rate. So as rates rise, that's passed on on the lending side, but the vast majority of our liability side, our funding side, is fixed in the medium term. So we benefit from that, from a rising interest rate environment in terms of our net interest margin.
I'll tell you what, it's always good to chat to you, Joseph Healy, Chief Executive of Judo Bank, small business lender, with first set of company listed profit results out today.
Thank you, Ross.